I'm Ryan Lightfoot-Brown, Research Analyst at Chelsea Financial Services. We're joined today by Mark Swain, Manager of the Smith Williamson Enterprise Fund. Hi Mark.
Hi there.
So being an absolute return fund, you've got the opportunity to short stocks that you don't like. Have you got an example of a company we might know that you're currently shorting?
Yeah, so Greene King's a current short position, and what we think this is a classic value trap. Their three main brands under their managed estate are very tired, and they need a complete capex refresh, which is a very expensive thing to do, and they've got a very income-hungry investor base. They pay a large dividend. The problem is they need to make a decision whether to refresh the brands because the trading is poor, but that will probably require a dividend cut. And this is in the face of a very difficult consumer environment, with the consumer being real income being squeezed, and also a huge amount of casual dining suppliers come onto the market.
Okay, thank you. And conversely, have you got any stock ideas that you do like that you're currently buying along?
Yeah, so SuperDry is a company that we're very, very excited about. There's a very strong global rollout story here, and they're always the best stories in the retail space. If you're increasing your volumes, then that gives you a much stronger hand when it comes to negotiating terms with suppliers. And so that's a very sort of exciting proposition. It also plays into the athleisure theme. They in the past have had a very difficult US licensing agreement, which they've now extracted themselves out of. And the final piece of the puzzle really is that they've invested very heavily in their distribution and their online proposition. And online is really what differentiates retailers from the winners and the losers. They've invested heavily in this, and that's going forward now is going to generate a huge amount of free cash flow, which will enable them to return that to shareholders, providing an attractive dividend as well as an attractive growth prospect.
So when is a long-short fund like yourselves useful for an investor? How should they have it in their portfolio?
So when equity markets have had a strong run and valuations are looking stretched, a long-short fund can provide capital protection. Mm-hmm. It also provides a great diversification. If your fund is uncorrelated to other asset classes, then it's a great portfolio diversifier. It's also a very good time to use it when factors such as currencies, commodities and bond yields are very volatile, very difficult to predict, because you can balance your longs off against your shorts, so you don't have too many dollar earners or too many oil related plays, so you can still play the individual companies without taking on board any more extra factor risk. The one last thing I'd say is that when stock dispersion increases, that enables us to monetize the difference between companies. And you quite often get a lot more stock dispersion as QE and macro factors play less of a role. So as QE has floated all boats, then the correlation between assets and between stocks are breaking down.
Great, that's really interesting, Mark. Thank you very much for joining us.
Thank you.
Cheers.